Hey, accounting scholars, welcome to Chapter 7, Section 3. And I assigned both Section 2 and Section 3 together here because I wanted to kind of give you some more practice on these various combinations um, so you could tie the kind of T accounts we talked about in Section 2 to some actual transactions. So let's take the first of the 8 basic combinations. If you could have situations where assets increase and assets decrease. And an example of this might be cash is used to purchase supplies. So you would debit the supplies account because you have purchased supplies, which is an asset, but you would credit the cash account because you've used up some cash. The second example is assets increase, liabilities increase. So in this particular case, supplies are purchased on. An example would be if supplies are purchased on credit, um, and so therefore your supplies account would increase and be debited, and your accounts payable account would be there would be an offsetting credit for accounts payable. Okay, the third example, it is assets increase, owner's equity increases. In this particular case, a customer might be billed for services provided, um, and in that case, the debit you would debit accounts receivable, that particular account, but you would credit fees earned. And for the last of the 4 on this particular slide of basic debit and credit combinations, you could have a situation where assets decrease but liabilities decrease. And in this case, you debit the accounts payable account, um, and which is a liability account, and you would credit the cash account, which is an asset account. So let's move on to 5, 6, 7, and 8. So 5, 6, 7, and 8 again are particular examples. So the fifth combination would be assets decrease and owner's equity decreases. An example might be here again, the supplies related examples. Say supplies are used in a business. That would result in a debit to the supplies expense account, but a credit to the supplies asset account. Second one, liabilities increase, liabilities decrease. Let's say in this example you have taken out a long-term loan or a long-term note payable, and you use it to pay off several smaller debts that you have, several smaller obligations. Uh, this would result in you debiting the accounts payable liability account, but crediting the notes payable liability account. In the next example, liabilities increase, owner's equity decrease. An example for this might be a bill for utilities is received, but you don't pay it. So in this particular example, you would debit the utility expense account, but you would credit the utilities payable accounts. And last but not least, a liabilities decrease and an owner's equity increase. Let's say an obligation to a customer is met. You have an obligation to provide services to a customer, and in this particular case, you would debit unearned revenue, and you would credit fees earned. Okay, guys, this is a mouthful, but please review this video very closely and make sure you understand again the logic of these particular account increases and decreases. Have a good evening, and I will see you tomorrow in class.